Hi, everybody. Welcome to the Patti Brennan Show. Whether you have $20 or $20 million, this show is for those of you who want to protect, grow, and use your assets to live your very best lives. As part of our podcast program, from time to time, we get questions. And today, one of the questions that we've been getting an awful lot is, how do I create a hedge against inflation? So, joining me today is Spencer Peet. Spencer is a member of our portfolio management team. We're so grateful to have Spencer with us, not just today, but he's chosen Key Financial to be his home. And boy, we're so grateful that he has. Spencer, welcome to the show.
Thank you, Patti. This is such an honor to finally get to do this with you. We've been getting a lot of questions recently about Series I bonds. We see on CNBC, Bloomberg, really on a lot of outlets getting questions about them. So, this seemed like a good opportunity to discuss them with you.
Perfect. So let's get right into it. So, I bonds. Where do you get I bonds? How do they work? They're a hedge against inflation, but there's actually two components to them, right?
Yes. So where you would go to actually purchase I bonds is treasurydirect.gov. And from there, you can either do an electronic I bond, which would allow you to buy $10,000 per person per year. So say you're married, you'd be able to do $20,000 per year. Now, for a paper bond, which is a paper I bond, you would be doing that through your tax refund. And your limit on that is $5,000. And then so the components of it are a fixed rate and then an inflation rate that is adjusted twice a year, in May and then in November. So recently, the fixed rate is about 0%. We haven't seen in the last 3 years that raised at all. And then that second rate is that semi-annually adjusted rate, which is based off the Consumer Price Index.
So that's interesting. So no ifs, ands, or buts, you're going to get a 0%. At least maybe in 30 years you'll get your money back, but you just don't really know what your rate of return is actually going to be until inflation is published twice a year, right?
Yes, that's correct. So that principal would be guaranteed depending on what you purchase in that year.
Okay.
But kind of above that fixed rate, that's going to be zero. And that secondary rate, that's kind of what's going to change moving forward.
Okay, so let's look back historically on that fixed rate portion. It hasn't always been 0%, right? I mean, it used to be, 3%?
Yeah, so in the last 10 years, it's basically hovered around that 0%. If we look back 20 years, early 2000s, that's where you start to see the fixed rate was between 2 to 3%. But recently, no, we have not seen that. You kind of go back a while.
And for people who bought it way back then, inflation really wasn't an issue, so they might have gotten that 2% and maybe another 1 for inflation or 2 for inflation. Again, not a bad deal, but it just wasn't the rate of return that many people got in other instruments, right?
Yes, correct.
Okay, well, fast forward to 2022, and it's a whole different ballgame, right? Yes. I mean, these are paying over 9% right now, right?
Yes, so right now it's actually 9.62%. So that semi-annual adjusted rate is 4.81. Multiply that by 2, and that's how we arrive at that 9.62.
Not a bad deal. And it sounds really high, but let's face it, guys, that's what inflation is, right? So it's a hedge against inflation and a good place for what? Part of the investment portfolio, Spencer, or what? How do they work?
From our perspective, we use the 3 pools of money. That first pool being the 1 to 2 years of cash flow needs. That second pool being from 2 to 5, and then past 5 is that where you're looking for the long-term investments. Now, a Series I bond, in that 0 to 1 year, you're not even allowed to redeem it.
Oh, so you can't even if you wanted to. No ifs, ands, or buts.
Nope. In the first 12 months, you are not allowed to redeem it. And then from that 1 to 5 years, you actually would be penalized for 3 months of interest when you redeem that bond.
Okay, so, and the 3 months of interest is basically taking away some of that CPI, assuming that there is CPI.
So, for example, that 4.81 that I mentioned, that would be halved.
Okay, so then the question is, okay, so there's different types of government bonds. We've got these I bonds. You've got the limit of $10,000 per person in a household. What about TIPS, Treasury Inflation Protected Securities? That's also a Treasury bond. How do they work? How do they differ?
Yeah, so one of the main differences between a TIP and an I bond is that a TIP you can buy on the secondary market. And, with I bonds, they guarantee that principal amount on your initial purchase. Now, the tips, because it's on the secondary market, it's subject to the supply and demand and whether people actually want and how they value that bond.
So you're going to see some fluctuation in
Yes.
the value of the bond.
Mhm.
Okay. So pros and cons, it might be a little bit more liquid, but you're going to have to deal with fluctuation,
Yes.
in exchange for that liquidity. In terms of portfolios, like when people are calling, what are we telling them in terms of, is that an important part of their portfolio? How are we using I bonds for client assets?
Yeah, so when we're talking to clients about I bonds, first we always want to mention, unfortunately, we can't purchase it for you. That's where you go to the treasurydirect.gov and you can apply online or the tax refund, like I mentioned earlier. But we always just kind of like going through and educating people about I bonds. I think that you see it so much in the news that people want to know, but they don't always have the background in it. But just try to educate them. If it's in that 0 to 1 year time frame, this isn't going to be good for you. Maybe if you have an emergency fund that you're looking for in the next 1 to 5 years, this could be a good spot for an I bond. But then if you look at out 5 years, we would prefer, being in equities. Yes, there's some downside and volatility with equities, but on the long term, an equity is most likely going to outpace an I bond.
Okay, so we mentioned equities. What about bonds in general, especially given how much they've lost this year? I mean, what's interesting about this whole conversation is that if you look at I bonds and the rate of return that they are achieving this year and compare it to a 20-year treasury, 20-year treasury bonds are down 31%. That's huge fluctuation in 1 year that you wouldn't have with these types of bonds. Now, that's bad news, but maybe it's also good news, right? Because they are down so much, what is the likelihood that treasury bonds are going to be down further 5 years from now? So that begs the question, is an I bond a good long-term investment, or is it more of an emergency fund alternative?
Yeah, no, I definitely say it would be an emergency fund. With the Fed's policy recently, I think they with the tightening, I don't see it going much further. They said they're going to continue to do it, but you've already seen even with the UN member that came out and said that they wanted to kind of decrease rates already in this past week. I don't see kind of the public getting on board to fight this inflation for another 2 years if it were to happen. So hopefully, in the short term, rates would be alleviated.
And the thing about inflation that we also have to keep in mind is it is a comparison year over year. So it's already high. What is the likelihood that 12 months from now it's going to jump another 9% from where it is? I'm not so sure. I doubt it. Seriously, especially given what the Fed has come out and said. They are not fooling around. They're going to increase interest rates, and they're going to keep them there until they're certain that that inflation is getting back down to that 2% target range. So again, just to summarize, I bonds, TIPS, inflation-protected securities of any kind, not a bad security as an emergency fund. I kind of like it as an alternative to money market accounts because it's going to take a while. Money market account interest has come up, but it's not at 9% yet. Eventually, it might catch up. In the meantime, a portion of your emergency fund certainly can be invested in these inflation-protected securities, whether it be the I bonds or TIPS. So, Spencer, what do you say? To summarize all of this, I bonds, a good alternative for your emergency fund, as long as you're not going to need them for the next year, because you cannot redeem them in the first year, and you're going to lose 3 months of interest for the first 5 years. But hopefully you're not going to need your emergency fund. It's there legit for just emergencies. And if you have an emergency, okay, so you're going to pay a penalty. But it's better than having to sell something when the market is down 25%. So I think it's a reasonable alternative. Now, you have cash equivalents like money market accounts and that sort, but money market accounts really are not even close to keeping pace with inflation yet. Eventually, the interest will come up, but that hasn't happened yet. So I kind of like this, and I think that you do as well, as an alternative for a portion of the emergency fund. Again, I really like the liquidity aspect of just having money in the bank. So Spencer, Pete, thank you so much for joining me today. And thanks to you for joining me today. I hope this has been helpful. Again, it's another, arrow in the quiver in your fight against inflation. It may be for you, it may not, but we just wanted to kind of break it down in a way that you can understand it. And hopefully this has been helpful. I really appreciate you tuning in. In the meantime, I am Patti Brennan. Thank you so much for joining us today. We're Key Financial Wealth Management with wisdom and care.